afternoon?
Doing great, Dave. How are you?
I'm doing well. And we're going to talk about investment philosophy today,
Yeah, always
which,
something fun to talk
yeah,
about.
well, and the first thing to know about investment philosophies is you should have one, right?
Yeah, absolutely. That's a great point too, Dave, because I think a lot of times people, especially if on the client end, if you're going and you are making an investment of any kind with a financial professional, you really ought to ask them, hey, what's your investment philosophy, and make sure it
Right,
measures up to kind of what your expectations are.
right. Because there's a lot of different philosophies out there, and as I said, the most important thing is to have one.
Mm.
Um, I always like to quote Yogi Berra in these situations with, if you don't know where you're going, you might not get there. And that investment philosophy is kind of the roadmap to make sure you get where you want to go and understand your directions.
Yeah, and I think that's a great point. I think everybody, like I said, should ask those questions, and I can tell you what an investment philosophy is not. It's not a sales pitch, right?
Right, right,
um, it's just kind of, how you feel about investing and how you're going to go about taking care of a portfolio. And intuitively, as the person who is being advised or making investments, that should align with kind of what your thoughts are, and it shouldn't be written in a different language. You should be able to understand it, and it should make sense to you in kind of how you would like to see your assets be invested.
right. And so we've kind of distilled our investment philosophy down to 10 declarations,
Okay.
and thought it'd be fun to walk through that and share them with our audience. And not that you need to adopt our investment philosophy, but it should at least serve as food for thought for how you would want to approach the markets and how you would want your advisor to think about your portfolio if you're working with a professional.
Absolutely.
So point number one is, we accept the fact and acknowledge the fact that short-term market returns cannot be known or predicted.
Right, exactly. We maintain the belief that we do not have a crystal ball, and nor do we want to have a crystal ball. We maintain the belief that we can't predict it, and create our philosophy knowing that in the short term, we don't know what's going to happen.
Right. And part of the human brain wants to like be able to look back and see causality for everything, and there's this human instinct to be able to say, oh yes, the markets were up today because XYZ happened. And the media is very good at saying, here's the market report for the day and here's why. And it kind of creates this impression that if you could predict the why for tomorrow, you'd know what was going to happen, right?
Right.
Right. And yeah, tomorrow's why you can ask at 4 o'clock, and we'll be able to tell you what the thoughts for the day were.
That's right. And interestingly enough, if you watch any of the market pundits or, the CNBCs, you don't hear a whole lot about, hey, well, this is what the stock market's done in the last 10 years. It's always about what happened in the last 5 minutes and what's going to happen in the next 5 minutes.
Right, right. So part of that philosophy stems out of the idea of market efficiency. The markets are usually efficient, and what that means is that the markets move in time with information. And so when a new data point comes out about the economy or about a particular company, that news is incorporated into the markets almost instantaneously.
Yeah, and so the main takeaway is it's extremely hard to pick individual stocks because of this efficiency, because this
Mm-hmm.
information is out there and it's acted on so quickly. It's almost impossible, and it really is impossible most of the time, unless you get lucky to get ahead of one of those trends.
Right. And so the price of any asset on any given day is the average value that every market participant assigns to the news that we know. So, if somebody's buying a stock, they think that the news that is known about it about that company warrants a higher price, but somebody else is selling them that stock and they think that it's fairly priced or even higher than it should be based on the news that's out there. But that price today is essentially the price that everybody's agreed to.
Right.
And, I always, to put it in real world terms, early in my career, I had a lot of GM retirees as clients, and I would hear things like, oh, GM stock's really going to take off because the new Corvette's coming out in 3 months. And, I'm pretty sure everybody that follows GM stock already has a pretty good idea when the Corvette's coming out, right?
Right.
And it's, it's built into the price. It's the surprise that isn't built into the price. Like if GM suddenly has a recall on the Corvette and they announce it tomorrow morning, that's going to be news that's going to move the market. Or it can work the other way too. Maybe they thought they were going to have a recall and it's not going to, not going to have the impact. But everything that is already known about the company is built into the price where it is today. That's efficiency. We use that term a lot, so it's important to think about.
Yeah, for sure.
So the next, declaration we would make is you've got to understand that risk and return are related. If you're going to expect a higher return on your portfolio than, say, savings accounts or CDs at the bank, you have to take risk.
Yeah, I think that's a great point, and I think it's one that everybody should really, not only is it related to investing, but a lot of things in life as well. But just this kind of thought process behind, there's no easy ways to get rich quick, especially when it comes to investing. If you think that the next stock that's going to be Amazon, and you go out and purchase that, you may be right, but do not be fooled by the fact that you also may be wrong. And in order to be right and to get those kinds of gains, there's a tremendous amount of risk that goes along with that. And I think that sometimes people miss that kind of relationship between risk and reward. Anything that anybody tells you is going to have a great return also is going to have a great risk. And comparing that to, what the other available options are.
So two things that come out of that declaration. One is usually when we talk about taking more risk in a portfolio, we're talking about using more stock in the portfolio. If you just think of things in simple terms of cash assets, bond assets, and stock assets, the more stock you have in your portfolio, the higher the expected return, but the more that return is going to vary and fluctuate over time. The other thing, and I think this is important, especially in times like this, since the Dow hit a new record this week, right? So a lot of times their response to that is, well, the market's really high now, so we should wait to invest. Well, that philosophy of risk and return being related would still tell us that if you want to expect a higher return over time, you don't wait, you get invested now, because over time we would still expect that stock exposure to lead to a higher return.
Yeah, that's a great point, Dave, as far as, when to invest. The Japanese proverb of when the best time to invest was, or the best time to plant a tree was 10 years ago. The second best time is right now.
Right. Yeah, that's perfect. That's perfect. Yes. And so also along the lines of risk and reward, the next point we would make is one we've made before. We did almost a whole podcast on the idea of systemic risk and non-systemic risk, and taking the right type of risk is important.
Right.
With non-systemic risk being the company risk of buying individual companies, and you can get rid of that risk by diversification. So, owning many companies as opposed to one stock takes some of that risk away. And the important thing about non-systemic risk, that risk of owning one company, is that you don't expect your returns to go up based on owning one company.
Right. Yeah, I think that's a great point. And we definitely touched on that in our previous podcast. But so if you haven't listened to that one, make sure you do. But it's just one of those, individual stocks as a whole typically are not a great idea. They're definitely not a great idea for an entire portfolio. Maybe on a smaller scale as more of a sentimental type of thing. And this is the exact point or the exact reason why, because you're taking on risk that you don't necessarily have to take on and you're not being rewarded for it.
Right, right. So everybody spends their energy, or I should say, a lot of investors spend their energy focusing on picking stocks and picking mutual funds.
Mm-hmm.
And the next point we would make as part of our philosophy is that asset allocation is so much more important than investment selection. And studies have shown that asset allocation, or when we say asset allocation, we're talking about how you mix together stocks and bonds and cash type investments, right? Just to keep it on a high level. Then there's all different subcategories of that, but those decisions drive 94% of a portfolio's return. Which funds and which stocks you use to create that asset allocation only account for about 6% of the return you'd expect.
Yeah, so from our perspective, we spend a lot of time on creating asset allocations and not as much time on figuring out what the best mutual fund is going to be for that specific slots. And the reason is there's not really any, return for it. There's not really any, in my opinion, things usually can only get worse. They're not necessarily going to get better. So if we can buy an index, we know we're going to be in the ballpark. We might not be the best, but we're certainly not going to be the worst. And if we're not the best, we're going to be pretty close.
Right. Well, and I think a good illustration of that is, so obviously, as fiduciaries and as financial planners, we're always trying to use the best funds and select the best options for somebody's portfolio. But say you have a situation where someone owns a particular mutual fund that maybe isn't the greatest for its category, but there'd be large tax consequences if they sold it. Well, a lot of times we'll work around something like that, because even though it's not the ideal best candidate for that part of their portfolio, the difference is going to be negligible compared to perhaps what the tax cost of selling it just for the sake of selling it and replacing it with something similar would be. Right. So, that I think is it's not that it's not that we're not trying to use the best things. It's just sometimes you have to compromise, and you can get all caught up in whether one fund, and we're going to get into taxes and expenses here in a minute, but whether one is the best in that category versus something that's good.
Yeah, that's a great point. And I think the people that are, looking at mutual funds, trying to figure out what the best one is, are really going based on past performance, right? Yeah. Well, look at this fund. It, led the category last year. Well, usually those ones that lead the category do so either because they're taking on more risk than what the category is. And secondarily, a lot of times they lead one year and then they're the laggard the next year. So by the time you figure out they're the leader, it's too late.
Right. So portfolio expenses are another important factor. And so when we are trying to determine what the right candidates to go in a portfolio are, if the portfolio returns are only as good as what you get to keep.
Right.
So we're always keeping an eye on controlling expenses. And a lot of that times that means using index funds, passive approaches that aren't trying to pick the best. They're not trying to beat the market. They're just trying to replicate the market.
Yeah, and this has really changed over, the last 10 or so years because prices have gone down quite dramatically with trading costs coming down. And so what used to be an index fund and a active allocation fund, those prices used to be closer and they're going in opposite directions, right? The active funds are becoming more expensive and the index funds are becoming a little bit cheaper. And so that gap is widening, which is why we've steered more towards the index and passive, because that's a bigger difference than it used to be. Right.
And when we talk about it, an index fund just tries to match a particular part of the market rather than trying to pick the best stocks in a particular category. and so part of that is that, studies have shown, there's piles of research that show that most active managers don't outperform their benchmarks when you adjust for fees. So you'd be better off just trying to replicate the benchmark, which is what an index fund does. So taxes matter. So along with fees, what you pay Uncle Sam for your portfolio makes a difference too. So, when we're dealing with portfolios outside of retirement accounts, we need to make sure that they're managed tax efficiently.
Yeah, and I think this is something that gets missed an awful lot. At least it does when we have clients that are coming in with portfolios. Just the active tax management and understanding what your tax situation is and being able to manage it on an ongoing basis. This isn't a decision between, hey, let's buy tax efficient mutual funds and bonds versus taxable ones. It's also a, hey, here's what's going on with my tax situation this year. Here's some opportunities to improve that situation throughout the year. So it's an ongoing process.
Right. So one of the things that we've seen is that you can manage asset allocations within the markets as long as it's done cost effectively and add to return over time. So using models that maybe emphasize particular sectors of the market based on economic conditions can lead to outperformance. As long as it's done cost effectively, that's the main thing.
Yeah, so definitely one of those where it can add value, it can make an impact, but we're always very careful about how we do that. And so, we're never going to overweight a category that it's going to increase a risk level too. And that's another thing to keep in mind is just because we can add value, if it's done cost effectively, doesn't mean that we want to add value and add risk. We want to be very careful of how and when we add value.
Yes. So there are also factors that have been identified that lead to long-term outperformance, and we tend to favor funds and models that will overweight those factors. So, for example, smaller companies tend to outperform larger companies over time as a group, and companies that are considered value stocks compared to growth stocks tend to outperform over time.
Yeah, and I think the key one there is over time. And as we talk about, we're always long-term focused. In the short term, there's lots of different cycles where growth outperforms value and vice versa. But in the long term, it always kind of returns to that mean. And that's what we're looking for when we're creating portfolios. What is a long-term strategy that we can implement and then make sure that we're not, tempted by or changing things based on short-term outcomes.
So our 10th and final declaration in our investment philosophy is that complexity does not mean outperformance. And I can't emphasize enough how many times, this situation we're in right now with very low interest rates and very low returns on bond funds and low expectations is a great example, because how many emails have we gotten in the last few days from bond fund companies that have this new approach, claim to have this new complicated approach that takes some of the risk or provides more yield. Those things always come at a cost. I think that's the best way to put it. And just because a philosophy is complex doesn't mean it's a better approach to investing.
Yeah, I think this is definitely one of my favorite points on our investment philosophy that we buy into. Complexity usually means somebody's making money on something because it's complex. And so complex means usually pay more for it. But like you said, in there, a lot of this business is still derived from that sales aspect. So they're trying to create a sales pitch, and they're playing on one of two things: either FOMO, right, fear of missing out.
Yep.
So you don't want your portfolio to not get in on this bond fund or whatever it is. And then the other one is loss aversion, right? You don't want to be sitting down 40% when the market has a huge correction. So you should buy into our complex strategy. And will those things usually are based on past performance and had merit based on past performance. Very rarely do they translate into what's coming next. And I think that's a distinction too.
Right. Like funds that have low volatility in the name.
Right.
Or, they're basically hedging those portfolios so that they don't move as much. And this isn't the place to get into complicated hedging strategies. But those things come at a cost. They're going to limit your upside in the good times. They may limit your downside in the bad times. But a lot of times those strategies were built for the last problem. Right. And, what worked to prevent downside risk during the financial crisis is not necessarily the same thing that prevents downside risk during the COVID crisis or whatever the next thing will be. Whatever it is, they'll build a fund that would have beaten it.
Right.
But, by then it'll be too late. So, and sometimes complexity can just be as simple as having a ton of moving parts. Some very effective investment strategies can be just a handful of funds managed very passively and get the job done.
Yeah, and I think that's a great point too, because one of the hardest things as an investor is sometimes the best thing to do is not do anything at all.
Right.
And that goes in the face of almost everything we've been taught about life in general, let alone investing. And unfortunately, that's not what people necessarily want to hear a lot of times when they call and say, hey, what's going on with the market and what should we do?
Just do something.
But it's our responsibility to do what's in our client's best interest. And sometimes that means we're not going to do anything. Most of the time, that means we're not going to do anything because we've done all the hard work beforehand and set up the right portfolio so that when the bad times come, we don't have to panic and we don't have to make changes.
Yeah. And kind of in line with that, how many times during the last 12 months did we say, we didn't invest your money thinking times like this weren't going to happen,
Right. Yeah, exactly.
So at the end of the day, these things boil down to the idea that staying invested over the long haul in a portfolio that is tax efficient, cost efficient, and takes the appropriate amount of risk for someone's goals is the key to long-term success.
Yeah. And that really, it's not only about creating the portfolio, but also about living with and letting the portfolio continue to grow. So, but yeah, that's our philosophy and what we believe in. And we've been in this business long enough to see a lot of different things out there, a lot of different strategies. And this is the one that we kind of always have come back to. And we've seen it be successful in our years. And we've seen it be successful for a lot of people over a long amount of time.
Yeah. And I guess the thing I would say, to folks out there who aren't clients is you should understand the investment philosophy that you are using or that your advisor is using. And if you don't, you should talk about it. And odds are, if you're working with a professional, there's at least, some, philosophical background to it. So there is something you can hang your hat on. But you need to know what it is and how it fits and what you're comfortable with. And there are people out there that are going to hear our investment philosophy and say, nope, you know what, that's not for me. I want to be picking stocks and have an active, and at least, we'll know that going into it.
Yeah, absolutely. And I think too that, the importance of having a philosophy and writing it down, whether or not, you're working for us or you're working on by yourself or you're working with somebody else, is that there's always going to be opportunities and things that spring up that you're going to say, oh, that's interesting. And going back and being able to go back to your philosophy and say it doesn't really fit in with my philosophy, and so I'm not going to do it, is super powerful. I mean, look at
Right.
guys like Warren Buffett who have, created a masterful investment philosophy. One of the big reasons why he didn't get into technology back in the late 90s, because he just didn't understand it and didn't fit with his philosophy. And obviously that played out really well for him during the tech bubble.
He looked really bad right up until he didn't.
Yeah, exactly.
Then he looked brilliant. Yeah.
Right.
So,
but that's just him staying true to his philosophy. And so having a philosophy and being able to stay true to it doesn't mean it can't change and develop over time, but you're not going to just change on a whim. You're going to, it takes time to update and make changes based on things that are happening.
It reminds me of back in the day when we were more investment oriented back at the beginning of my career, and a lot of the folks that we met with also did stock trading on their own. It was still the day trading era. And I remember talking with a senior advisor who told his clients in those situations that when you buy it, because the hardest thing to do is it's easier to research and choose a stock or a fund and buy it than it is to know when to get rid of it.
Right.
And so, he had them create a philosophy of their own just by writing down the three key reasons why they were making a certain investment. Whether it was a stock and you're buying it because, hey, it's at $100, and you think it's going to go to 150, or it's a bond fund because you need some safe money for a certain, outcome. Write down why you're buying it, and pull that out once a quarter, once a month, whatever your time frame makes sense. And read it back to yourself and look at your portfolio. And if those things aren't true anymore, it's time to make a change.
Yeah, that's good. I like that. It takes a lot of the emotion out of it.
Right. So it doesn't have to be a, 10-point, industry veteran jargony investment philosophy like you and I might create to at least have, some beneficial effects.
Absolutely.
So that is our philosophy and we're sticking to it.
Yeah, I like it. So as always, if you have questions on investment philosophy or anything else, feel free to reach out, info@srbadvisors.com. Otherwise, we look forward to seeing you on the next one.
Yep. And we'll have the 10 points in a document on the website with this podcast note. So thanks, Nick.
Sounds good. Pleasure as always, Dave.
Yep. Take care.